Another way to measure a company's ability to pay long-term debt is with the times interest earned ratio. To compute the times interest earned ratio, we divide income from operations, also known as EBIT, by interest expense. So EBIT stands for earnings before interest and taxes. It's revenue minus operating expenses. So now the debt ratio that we talked about before says nothing about the company's ability to pay interest. So before we even get to the long-term debt, we have to survive our annual interest expense. So this times interest earned attempts to measure our ability to pay our interest every year. So it's measuring the number of times EBIT can cover or pay interest expense, and higher is better. It's also called the interest coverage ratio. So now let's move on to measuring profitability. In business, the term return is used broadly as a measure of profitability. So if you see return, like return on total assets or return on common stockholders' equity, it's a profitability measure. But we'll first start off talking about the profit margin. So the formula for the profit margin is simply net income divided by net sales. So it's trying to measure how much net income do you have for every dollar of the thing on bottom. So how much profit do you have for every dollar of sales? So the higher the rate of return, the more sales dollars end up as bottom line profit. So if you get a result of 0.25, which is 25%, that means for every dollar of sales, 25 cents is profit. Is that good or bad? Well, it depends on the industry that a company is in. Software industry has really high profit margins, so a result of 25% would be pretty poor. So let's look at this company. How does this company compare to the industry average? Well, their profit margin ratios are between 3 and 5. Doesn't sound very good until you learn that the industry average is 1.7%. So this company is actually doing very well. So this could be like Costco or some supermarket because they have pretty low margins. Return on assets, also known as ROA, measures success in using assets to earn a profit. Before we talk about how to calculate, let's remember that assets are financed by two groups of people: creditors, those that loan money to the company, and owners. For instance, let's assume a company owns one asset, a truck. It is financed with a $10,000 loan, with the rest being equity of the owners. So this asset is financed by the bank, which owns $10,000 of the truck, and the owners, which own $40,000 of the truck. So the numerator of the equation is the return of these two groups divided by assets. So what is the return of creditors? The return of creditors is the interest expense that the company pays. What's the return of the owners? The owner's return is net income. So the top part of the formula is net income plus interest expense. And then the bottom, we're going to divide by average total assets. Now remember, to calculate average total assets, it's the assets at the beginning of the year, which is also the same as the assets at the end of the previous year, plus the assets at the end of this year, divided by 2. This is also known as the rate of return on total assets, but no one calls it that. Everyone calls it return on assets, or ROA. Now let's talk about the asset turnover ratio. This measures the amount of net sales generated for each average dollar of assets. So again, we're going to have assets on the bottom, but now we're trying to measure sales, so sales is on top. So it's going to be net sales divided by average total assets. So it's going to measure how well a company is using its assets to generate sales revenue. This number can vary from industry to industry because certain industries are asset heavy, such as a company like Boeing, whereas software companies are not asset heavy. So these ratios will be different for each industry. So always compare to the industry average.